So it's 9 o'clock here in Washington, D.C., and we're waiting for our participants to trickle in. So we're going to give it a minute before we start formally. But yeah, this discussion is going to be extremely interesting given the topic and given the historical moments that we are in. So as Stimson, as a China program, we're hosting a series of discussion about that sustainability issue and also the world economic recovery in light of the there seems to be the end of the tunnel coming to the COVID pandemic crisis. And we have several papers being drafted on this topic, and the Lex has already contributed to the paper. We very much look forward to the finalization of the paper, and hopefully that we will release it in a couple of weeks. Let's just hope. Okay, I think people are trickling in, and I think we could get started. Now it's 9:01. Without further ado. Well, welcome everybody. Welcome to this morning's seminar at the Stimson Center. My name is Yun Sun. I'm the director of the China program and the co-director of the East Asia program here at the Stimson Center. And today we're going to focus on an extremely interesting topic, whether the global financial sector is fixable. That's a huge question. We are at a critical time with basically two crises hindering the global economic recovery. We have the COVID-19 pandemic is still ongoing, and most of the world has plunged into a major economic recession last year, with only a few countries achieving positive economic growth throughout the 2020. With vaccines being distributed, the most pressing task faced by the world will be how to reinvigorate the world economic recovery. There are individual efforts being made by different countries, but the bigger question is whether the global financial sector will be able to produce some of the momentum and some of the required conditions for the economic recovery to happen. So to answer and to discuss and hopefully answer this tremendous question, we have two fantastic scholars here today to give us some of their thoughts. We have Lex Rafel, who is a non-resident fellow with the East Asia program here at Stimson. He has had a long, distinguished career with Brookings, with Institute of International Finance, with Treasury Department. And from 2001 to 2009, he was also teaching graduate seminar on financial issues in emerging market countries at Johns Hopkins University, Syracuse University, as well as George Washington University. So if you wish to read Mr. Rifel's very long, distinguished career and his background, you can find it on the Stimson website. And also we have a Professor Andrew Shang, who is a distinguished fellow from the Asia Global Institute at the University of Hong Kong. He's a former central banker and a former financial regulator. And he writes widely on Asian perspectives on global issues, with columns in Project Syndicate, Asia News Network, and Caixin Magazine of China. His latest book is Shadow Banking in China, co-authored with Wu Chou-sun, published in Wiley. So without further ado, Professor Sheng, I would like to give you the screen so that you can introduce to our audience your thinking about this question. Thank you, Professor Sheng. Oh, by the way, throughout this session, the Q&A function will be on. We have a staff member monitoring the Q&A section. So if you have a question, please feel free to put it into the chat box, into the Q&A box, and we will be organizing those questions and post them after Professor Sheng's presentation is completed. Thank you very much, Professor Sheng. The screen is yours.
Thank you very much indeed, Yun Sun. I want to thank the Stimson Center and my old friend Lex Riefel for inviting me. This is a big topic, so I've got a PowerPoint that I really want to share with you. So let me get this up. Okay, it's the topic is fixing the global financial system, an Asian perspective. Now, to sum up the key issues, right? We're at a very critical time in which the financial system is something like 4 to 5 times larger than the real GDP. The present global financial system was set up under the Bretton Woods system by the United States, with the World Agreement. It functions around the US dollar. It has this free market liberal philosophy. But as Junsun said, we've just had the two crises. My view is there are three crises going on at the same time. It's not just a pandemic, it's not just an economic crisis, but it's also a climate change crisis. That's a little bit longer fuse, but it's all entangled together. But the result of the pandemic is that we've created big government. Government is bigger than ever. Government deficits are bigger than ever. We have huge big tech because everybody's moved online, and global debt is bigger than ever. So the whole game has changed since 2007, 2008 with quantitative easing. And in the last 5 years, cyber money plays a big role. Now, as I mentioned, climate change is demanding huge investments in the future to deal with future problems. And at the same time, the rise of China, India, and emerging markets is creating, a geopolitical shift out of a unipolar situation to a multipolar situation. And so my basic bottom line is this. If the United States, which is the key architect and shareholder of the current system, doesn't work with all stakeholders to fix the present flaws in the financial system and benefit herself, the world will be in deeper trouble. So because the world cannot fix the IMS without US leadership or consent. Now, let me start with an overview. Well, Ray Dalio, who's just written this new book called World Order, is a very famous chart showing the rough estimates of relative standings of great empire. And as you can see, the blue line is the United States. It seemed to peaked around 1950, and then it's declining, and China is the red line, going up. That is the geopolitical situation. But what is finance? Finance is now interconnected, interactive, totally entangled. And out of a sudden, we used to think the basic core of the financial system are the banks, right? And the banks are still very, very, very important. But look at what's happened. The central banks out of nowhere are now $40 trillion in assets. Remember this, the world GDP is around $87 trillion at the present moment. Pension funds are now about the same size as central banks. Insurance companies are smaller than central banks. Mutual funds are just slightly bigger. Okay. And central banks are now buying, say, for example, the Bank of Japan, half of the JGBs and 75% of the Nikkei ETFs. So will central banks, backstop all the financial markets? This is a real critical issue. Let's look at the total share, right? The total financial assets today is $404 trillion. All right, and this was in 2017 at 30 trillion. They've increased 10 trillion since then. The banking system is still very large, but the banks account for about 40% of global assets. So, but what has happened since then? Even since 2017. The shadow banking system is now half of total global financial assets. The reason why the Fed and the ECB and Bank of Japan had to intervene massively in March was because the pandemic caused a stock market crash, and the money market funds, the fund market, had a liquidity shakeup, which required massive bailout. And so the central bankers are now thinking about how to deal with this systemic problem, which they didn't fix in 2008. Okay, but let's look at the global system. The global system is that the US dollar, the euro, and gold are still the dominant reserve currencies. Okay, the US dollar is important, the euro's second, and the next one is gold. Japanese yen, sterling, and Chinese renminbi pretty small. Okay, very quickly, right? So having a very quick, simple history of global finance. In the 70s, the Americans' banking system expanded worldwide, creating the euro dollar market. and lending to emerging markets, particularly Latin America, which saw a Latin, so in the 80s, a Latin American crisis, right? In the 90s, the Japanese, started coming in, and then there was a 1997 Asian financial crisis. In 2000, there was a Nasdaq tech bubble. There was quite a lot of reforms, but there wasn't enough. By 2007, 2009, there was this, subprime crisis in the United States, the debt crisis in Europe, and that's where we are now with a massive base. So all these we've seen, and now I thought, every 10 years we had a crisis. I thought in 2017 we would have another financial crisis. It turned out to be a political crisis, because basically the financial system was bailed out by central banks. And in 2020 we have the pandemic, okay, which is also a political, tech, and moral crisis. And so what are we going to do? Okay, this is the issue now. Now, if we were to look back, the US dollar took 70 years to overtake Britain as the reserve currency of the world. In 1870, the United States GDP was already equal to the size of the British Empire. But it took 70 years for reforms in the New York interbank market, the American banks, learning through different crises, and eventually took over, right? And today, the United States dominate the global stock markets. It accounts for 40% of the world's 45%, of the world's stock markets. But this is itself a problem. The United States stock market is 181% of GDP. A 30% drop in the US stock market would be equivalent of a wealth loss of 54% of GDP for the United States. So the stock market is both a boon and a bane. All right. And then if you look at the debt market, of course, the debt market doesn't drop like that. But, the last week or so, when there was a fears about the US dollar interest rates and inflation, there was also a little bit of a hiccup. Now, the US debt also accounts for 40% of the global debt market. Okay. But the problem now is that the US net international deficit is $14 trillion, or 63% of 2020 GDP. Now, I wrote the book on the Asian financial crisis, and in that crisis, any country with 50% of net deficit to the rest of the world had a financial crisis. Okay, the United States has already passed that limit. So the key question is whether the US, can do so. But the US can do so because of the unique position of the dollar. So if you really look at the surplus countries and the deficit countries, there are the deficit countries. There's an 18 trillion deficit, of which 14 trillion is the United States alone. Okay, and then who are the surplus countries? It's not China is there, but it's not that big. It's only 2.2 trillion. The big ones are Japan. There's Taiwan. There's Germany. Norway, Netherlands, Singapore, Switzerland, and all. But the system of which the United States is the leading borrower has become more and more leveraged as interest rates come down. So the financial system is hugely leveraged. Households are now more than 100% leveraged, and even the government debt is also leveraged. And as we all know, as Thomas Piketty has said, financialization has been responsible for the rise in global inequality. In 2020 alone, the top billionaires of the world increased their wealth by 27%, and the bottom half, in fact, had wealth declines, although, savings of the middle class rose. So the best way to look at how the central banks and the stock markets look is the S&P 500 index, which is this red line. And then this blue line is the total assets of the Fed, the ECB, and the Bank of Japan. It totally correlated, okay? So the stock market now just worries about central banks. If we drop, let the central banks bail us out. And this is total moral hazard, okay? But with the central banks getting larger and larger and playing a more important role, we have what is known as a global liquidity trap. And that was exactly what Keynes, warned us about, right? Too much liquidity not being spent. And, the central banks created $8 trillion liquidity. The sustainable development goals required 2.5 trillion in investing long-term assets, with long-term debt and near zero interest rates. And we still can't do it, right? So something is seriously wrong. Now, let me very quickly run through what has changed because of technology. Finance is all about money, right? I mean, money is actually an information. And information is physical. Everybody thinks about money as flows, but finance is information stored in ledgers. They're either hierarchical or distributed, right? And so if you basically you put the, sorry, I beg your pardon, if you put the resources into the battery and the battery leaks, you have value destruction. But if you put the deposits in the banking system or the financial system and there were corruption, there were asset bubbles, there are leaks, you're in the same damn trouble. And that's why we regulate banks. But finance is information across networks. Traditionally, we go through the banking system. That's why the US is so important. 60% of the global financial transactions go through the books of the Fed, ultimately. All right. But nowadays, if the private sector said, well, if we do this on a flat ledger, distributed ledger system using blockchain, we can completely avoid official surveillance. So we don't need to worry about anti-money laundering, illicit funds, etc. So these are huge issues. That really means that digital currencies are substitutes to the US dollars and fiat currencies. And Bitcoin and all are now already worth $1 trillion. And if they use more and more of this, this is going to create serious problems for the US. So what is the big picture? Step back a little bit and you look at this. At the moment, the world is in deep trouble. It's roughly 4.5% decline in 2020. China is the only one that grew 2.3% growth, right? And a few other smaller economies. But back to 2019, India and China basically account for more than half of global growth. And if you include, ASEAN, the Southeast Asian countries, Korea, etc., it's about 70% of growth. And out of this growth, the United States companies make a lot of profits from this region. And the more conflict there is in trade, the more you're going to damage US company profits, right? So based upon the general scenario is that by 2037, Asia Pacific, including, Australia and Oceania, right, will have half of world capital market size. Okay. But at the moment, all it needs is, the market fragmentation. A major study by OECD suggests that if China and India alone and ASEAN equity markets create their long-term pension funds, the savings will flow back to these high growth markets, that have rode the COVID best. So to a large extent, we're at this, global liquidity trap. How do we fix the system? Okay, so we have a financing gap of $2.5 to $3 trillion, right? And that excludes debt relief, balance of payments needs, et cetera, et cetera. And the idea is that there is more than enough money to deal with this. The Financial Stability Board has calculated, in fact, the United Nations quote $200 trillion. In fact, global trillion is $400 trillion. So there's no shortage of money to deal with these issues. Okay. The key question is political will. How do we do it? And that requires America, because America, runs basically the US dollar. The US dollar accounts for 60% of, a lot of the global, 45% of global transactions and, 60% of foreign exchange reserves. So what is the situation? Well, the international monetary system based around the IMF quotas, which is the shareholdings of IMF, at the moment, this line is the GDP share, and this is the voting share. Okay, the IMF and the OECD calculated that by 2035, if based upon the GDP movements, the voting share may have to reflect the GDP share. And then if you look at what would happen is that the Europeans would lose their control over the US, over the IMF. At the moment, the Europeans plus the United States have the biggest voting bloc. Okay, and which means that if you increase the quota shares of the IMF, etc., and the emerging markets take a larger share, you will look at China, for example, by GDP, 75% less than its GDP share. India, 77%. Okay, Indonesia, 64%. right? South Africa, 40%, right? Okay, so Turkey, 52%. So all the large countries, the emerging markets would want, and if the America and Europe can agree on reallocating, injecting the capital of the IMF and the World Bank and the development bank, global development banks, would be able to have money to not enough at the moment, but it will be a start to deal with all the problems that we have right now. So to very quickly sum up, the heart of the problem in the world is that everybody is trying to emulate the Americans. If everyone on the planet consume like the average Americans, we need 4 Earths. This is what the climate change guys tell us, okay? But the finance, actually including derivatives, is already 10 times larger. Now, as you know, you can't overspend if nobody is willing to lend to you, right? So, the money really represents power. And so to a large extent, uh, it is everything is to do with America as currently the largest economic power, the creator of the current system, okay? And the issue is if America goes for decoupling with China, right, continue the trade war, then maybe even the payment system will also decoupling with huge implications for the United States dollar. And as you know, the central bank digital currencies are being created to compete with the cyber currencies. And if these are then used to clear and settle cross-border transactions, the need for the US dollar intermediation will be less. So if the US doesn't resolve some of these high deficits, global interest rates will rise. If that happens, all the asset bubbles will reverse, which could lead to a financial crisis. So to prevent this, it is extremely important for the United States to lead, to reshape the international monetary system and to meet the global public good needs. Because without global cooperation, the international monetary system will be dysfunctional and it will be lose-lose for all. So on that note, I've spent 18 minutes leaving Lex enough time for discussions over this very complicated issue. I'm sorry for rushing you through a very complex issue, but I've tried to make it as simple as I can. Thank you very much indeed.
Andrew, it is indeed complex. There's a huge amount of information there to digest for us. And the Asian perspective, I really think, is important because the world is becoming more Asian-centered. I speak from the U.S. perspective, and what's a little bit curious here is that you seem to be the optimist, and I seem to be the pessimist. Let me start out by saying sort of one very simplistic way of summing up what you said is that in the world today, there's too much debt, too much liquidity, too much inequality, and yet the stock market looks bullish. I don't see any panic in the financial system. Are we on the verge of another financial meltdown? And if so, how soon and what's going to trigger it?
Well, I wouldn't be here talking to you if I knew the answers. Let's be realistic about it. The answer is nobody knows the answer. The issue is that the current trajectory of debt is unsustainable worldwide. It's only sustainable because it's zero interest rates, negative interest rates. And secondly, everybody assumes that the central banks will again step in big time. The real problem is central banks can't continue printing like this forever. And you recall the last time when Ben Bernanke was the chairman, he tried even the tapering, and that caused the panic. So the issue is whether they can unwind and allow the inflation slowly to remove the debt. But if you really look at the China problem, the China experience and the Japanese experience, debt is not a problem if you don't owe foreigners, point number one. point number two, debt is also not a problem if you have very high domestic savings. And furthermore, the third condition is that everybody talks about debt, but where is the asset? If you have invested in good assets, you don't worry about the debt, because as long as the assets have a real rate of return, social rate of return, higher than the nominal rate of liability, the cost of funds, you're okay, right? And China's debt has increased hugely, but if you really look at what's happened over the last 12 years, the Chinese were the only ones to increase real incomes for the labor force. They increase it overall, roughly 1 to 2% in real terms every year. Okay. The rest of the world had negative, so that the wage share as a percentage of GDP declined for the rest of the world. So are you surprised that actually, there's a lot of middle class and working class unhappiness at this point of time? Point number one, right? Point number two, the Chinese invested hugely in infrastructure. You go to China today, you would see, even discounting wastages, excess capacity, China has a very modern infrastructure and invested for the long term, including growing investments in R&D, in technology, et cetera, and especially green technology, right? So that has given them enough confidence to commit to the climate change carbon zero issue by 2060. Or not carbon zero, but carbon neutrality, actually. Now, if the United States would be able to do this also, and so is Europe, Australia, and all the others, then gradually, we may get the climate change issues under control. And, the investments in the long-term green infrastructure will take the world out of its low productivity trap. And as I said, the issue then is exactly what Keynes suggested, to get out of the liquidity trap and move the savings into long-term investments. Okay. Of course, Keynes got discredited in the 70s, and the monetarism came. Now monetarism has, overplayed its hand, like Keynes overplayed its hands. Keynesianism overplayed its hands in the 70s, right? So we really, we are worried that the theory actually is behind reality. Reality is now much, much more complex. But it really is about political will. It's not about, whether this theoretician is right or wrong. It really is about implementing real reforms. And that has been sorely lacking in the last 20 years.
So let me pick up on the political will point and bring up the topic of global governance. We have these G7 and G20 forums or systems, institutions. And in the past 2 weeks, there have been meetings of the G7 leaders and their finance ministers and central bank governors, and a G20 finance ministers and central bank governors meeting. At these meetings, the COVID-19 pandemic was the primary concern, but they were talking about fixing the global financial system. What I'd like to know, Andrew, is from where you sit, are these leaders focusing on the right issues and working towards sensible solutions?
Well, I think the last 4 years was a major setback, right? I mean, once President Trump said America first, then everybody said, well, okay, you America first, let me talk, my country first. And so the momentum for global cooperation actually was severely compromised, put it this way, right? Now it would then take leadership again to try and resolve this. And in this case, you hear some good noises from Europe. I think Mr. Biden, President Biden, has also made some good noises. Trying to get back into the WHO. Let's hope some also issues on the trade side, right? And the IMF reform is very top. From my perspective, top of the priority. And so it would be, very important that the Biden administration begin to commit into this area. The person who knows this very, very well is the Treasury Secretary Janet Yellen, who's a former central banker, somebody we all know and trust, and so we hope that she will make the right choices. But it's a political issue.
So let me reveal some of my pessimism here. You have argued that the United States must take the lead in fixing the global financial system. I have to say, from where I sit, it seems impossible in the near term. No, the time to do this was during the 8 years of the Obama administration. I think they wanted to do this, but they didn't have the congressional support that was necessary. I mean, I just see the United States having too many internal problems. We're too divided politically. We're becoming more isolationist. So if the United States won't take the lead, is there any hope for building a more robust, more resilient global financial system?
Well, I think everybody's is worried about at least three options, right? The first one is that the President Biden will step up and lead, and I personally have some hope for this. The reason is that if you really look at history, FDR also had a bad hand, right? America was fairly isolationist. People thought, why don't we fix our problem first? Why are we going to get involved with Europe and all their problems that they create? But FDR and his team, not just created the New Deal for America, but also the New Deal for the world, right? So it was a very important conversational shift. Okay, and the New Deal for the world was in the interest of America also, because a peaceful world is important for a peaceful America, growth. Okay, the same issue exists now, even more than before. You cannot have development without peace. Okay, if you're going to fight, I always say that some of the talk of the previous administration seemed to be like alphas trying to fight in a burning forest. Okay. And you can beat your chest all you want, the forest will still burn. Okay, so this is the time to cooperate, and what we need to shift our mindset is that yes, you may be number one, yes, somebody may be number two. There's always number three. There's always number four, and there's always going to be fighting. But and everybody said, oh, there's bound to be a collective action trap. It took a woman, Eleanor Ostrom, to point out that civilization arrived today because we overcame the collective action traps. The record shows that we are better at getting out of collection action traps than talking about it. So in my view, everything is possible. We will not be, well, we could be. That's always the fear. That we damage our own, concerns, shooting ourselves, on the foot, double barrel over climate change, inequality, and etc. Right. So this is now the opportunity for serious reform, and leadership is all about stepping up. So either you want to be a leader or you don't want to be a leader. That's the choice.
Yeah, I forget who said it, but one of these pundits in the past was saying that the United States never does what it needs to do until there are no other options, and maybe that's what's going on.
Well,
let me go a little narrower on this sort of pessimistic view of mine. You see a lot to worry about if the United States decouples from China. My best guess is that the United States will decouple from China over the next 5 to 10 years, and nothing can stop it. So my question is that really so bad? Is it possible that a less globalized world would be more stable at this point with all of these complexities that we've created?
You know what would happen if America really decoupled? the soya bean market, which is booming for the last 6 months, the bottom would have dropped out of it. Okay, the Australia would not be in a iron ore coal boom right now if it was truly decoupled from China. Okay, the tech sector is running out of chips, right? And who's buying the chips? It's China. So the decoupling is more talk and wishful thinking than reality. The world today is so entangled with each other, it's not going to be easy to completely decouple. Now, there's no question, no country today will want to have no domestic capacity to create medical protective equipment, to be over reliant on a foreigner, for anything that it concerns of national priority. But the world will also want to trade, because if you don't trade, you're not going to get out of this mess. Okay, you're not going to get out of this fundamental problem. So the reality is that decoupling is not going to be a clean decoupling, whatever people wish were to happen. If it does happen, we will have a global recession worse than the 1930s. That's my view. Okay, because we if that happens, this would be the equivalent of Smoot-Hawley Act in the 1930s, and ultimately, protectionism, this sort of decoupling is de facto protectionism, right? And the result is a global growth will be hurt, and it's not just the United States. I'm talking about the emerging markets. So everybody will be collateral damage.
Yeah, my fear is that the United States has been so good at shooting itself in the foot over the last 20 years that we may continue to do it. But let me turn to a more technical part of the global financial system, and that's cyber money. Nouriel Roubini recently had an op-ed published in which he argued that Bitcoin and its ilk are basically a hoax. You seem to view central bank digital currency with displacing the U.S. dollar as a problem. Can you go deeper into this matter and help us see the benefits and the risks? I'd like your view of China's introduction of this test of central bank digital currency.
Well, the problem with trying to move out of the US dollar is all the sanctions that are going on, right? The minute you sanction individuals, then you sanction the banks that deals with the individual. And then if you sanction the bank that deals with the individual, the bank doesn't know what to do. So the result is what they will do is they're going to move more and more transactions into an area that will not use the US dollar, because it was the use of the US dollar that enabled the United States to sanction, whoever they want to sanction. Okay. So take, for example, there were $300 billion of sanctions on the banking system post 2007, 2009. Most of that was really due to actually breaking sanctions against Iran, Sudan, etc. Okay, it wasn't really about breaching Basel II or Basel III or whatever it is. So to a large extent, this sanctioning has a cost, and that gave the opportunity with the arrival of blockchain to create the cyber currencies. Now, but once the cyber currencies started, central banks decided, why don't we do this? And if they do this, what then will happen is they can do all international transactions, netting this using the cyber currencies to settle, rather than using the US dollar. Now, as you know, a lot of the payment systems, this is a little bit technical, is real-time gross settlement. Gross settlement means that you have to settle in full. When you settle in full in US dollars, you have to have enough US dollars to settle in full. But if you settle net, and you settle not with US dollars, but you settle with a digital token, you can just net off what I owe you, you owe me, what I owe everybody else, you just net off at the end of the day. And then the balance, you use central bank money to settle it. right? That will save a lot on the need for US dollars. So that's a huge threat, right, to the US dollar. And so I hope the US Treasury and whoever's designing the sanctions policies understand this threat, because if once it starts, it won't stop. Because if the United States, for example, decides to sanction China, and then they put Chinese banks on this, do you know how many transactions are financed around the world through the Chinese banks? Huge amount, right? So the result is that these risks are very difficult for banks, not just the banks being sanctioned, but also the banks dealing with the banks that are being sanctioned. Okay, so they have externality effects that the world is having second thoughts about. Okay, so there are externalities to anything that you do. For example, using financial sanctions, it really is an issue. So then that's why the bitcoins are being used so massively. Let me give a simple illustration. If you were a refugee from Syria, would you carry cash in US dollars, or would you carry gold, or would you carry Bitcoin with your password in your head? It's a no-brainer, right? If you're carrying anything physically, you're going to be robbed. So if you carry any Bitcoin, you arrive in any station, you go to the nearest computer situation, and you can get funds that you need. And in fact, over the last 3 years, 5 years, if you had if you were that refugee and you had invested in Bitcoin, you would have made money. You wouldn't have lost money. You have made money. So these are all the perverse incentives that we are now seeing in the financial world today.
Let me follow up then on China's experiment testing of central bank digital currency. Are you suggesting that's premature? That's a bad idea? They should stop doing it?
No, I mean, basically, they said that, well, the digital currencies are happening. If the central bank doesn't do it, other people will do it, right? So therefore, if I'm not wrong, the Chinese digital currency is a cooperation either with one of the Gulf states and the Hong Kong Monetary Authority, and they're just experimenting with it and to see how it works. And I think the other central banks are very, very curious how it works. Would it work? So what the People's Bank did was in Shenzhen, they gave quite a lot of people the use of these digital currencies, and just see what the experience was. And I think so far the experience seems to be quite positive. I mean, if the central banks don't get into it, the private entities will get into it. I mean, why do you think the Fed is concerned about Facebook issuing Libra, right? If they issue Libra and you can see what technology is changing, will Walmart get into the financial sector business? Will Amazon get into financial business? They have a few 100 million clients. So okay, it's pretty big stuff. It's a big change. And if Tesla, is willing to accept Bitcoin to pay for cars, who's going to use US dollars? So, I mean, these are serious issues. I don't have Andrew, all the answers.
We're 3/4 of the way through this webinar, and right. It's time to look at some questions coming in from the audience. Here's a question about China's BRI financing program after the pandemic. I mean, with the debt sustainability question being highlighted by the pandemic, China is under pressure to do more prudent lending. But which way is this gonna go? And the whole BRI program raises a lot of issues, especially for Southeast Asian countries. And now you've got these different institutions. You've got the AIIB and you've got the ADB, maybe in competition. So how do you see this playing out?
Well, anybody who's willing to lend for long-term development, I congratulate. Because the problem is that after the 2007-2008 crisis, the European banks pulled out, and the amount of money that was available for really long-term, good green projects actually declined, right? Thank goodness the BRI came in. People say, wow, there is a debt sustainability issues. The real issue, if you really look at the debt sustainability issue, is this: is it unsustainable for the borrowing country, or is it a bad loan for the lending country? You can't have it both ways, right? So if it is a bad loan for China, some people say, I don't worry about that one. Well, if the country has to resolve it, well, if the lender and the borrower decides that there is, the original project in which the project investment occurred is a bad one, how do you turn it around? Will there be debt equity swaps? Will there be restructuring of the debt? Will there be more commercial redoing? From what I see so far, actually, if you really look at the BRI projects, there have been successes as there have been big lessons on failures, right? But the most famous one is the Sri Lankan one, and the port is still there. And in fact, transactions are beginning to increase, right? So the issue then is that, was it the capacity over design or what? And certainly, the real issue for the debt sustainability issue is really the issue for the global side, where there are many emerging markets that have debt not from the BRI, but from the other loans from the World Bank, IMF, et cetera, et cetera. In fact, even the high aid loans. This is a big problem, the Paris Club issue that needs to be resolved.
Yeah, that's in fact, that's the paper that I'm working on for Stimson, is China and the Paris Club, because I've done a lot of work on the Paris Club and debt rescheduling and so forth. There's an audience question about central bank digital currencies, and maybe I didn't understand the Chinese experiment. There's a big difference, this questioner says, between wholesale central bank digital currencies and retail central bank digital currencies in terms of the impact on the banking system, on the country's banking system, and the question is whether China is planning to move to a retail system from the wholesale system. I thought they were doing this retail now.
Yes, I think this is retail. I really do not see digital currencies being a major financial stability concern. I seriously don't. Not until it reaches a huge scale. But at the present moment, the digital currency is completely within the control of the central bank. But the Chinese one is definitely on the retail. The pilot is on the retail side.
I have another question about the liquidity. How would a liquidity squeeze potentially triggered by rising interest rates in response to inflation in the U.S. affect emerging market economies that do not have debt denominated in foreign currencies?
Well, I think what has now come about is that even if you don't have debt denominated in foreign currency, the very fact that the foreigners hold a large amount of your debt, you're going to be affected. Okay, and the issue is quite clear. The emerging markets have need to borrow, because by definition they run current account deficits, and they need to borrow. Now they need to borrow because they're also spending, buying things on the global market, right? So they add to global public goods, as it were. They contribute to the global economy. If they completely drop out, global demand, aggregate demand would decline, right? So the whole financial system, global financial system, is really about this. In the old colonial period, and to some extent even under Bretton Woods, the emerging markets saved with the advanced country reserve currencies. And then this is recycled back through their banks and asset managers and reinvested by the emerging markets, including through the Bretton Woods institutions. That recycling is gone. But that recycling has stopped because, number one, aid flows have declined. Number two, the capital of the IMF, ADB has also, is not sufficient relative to the demand. And number three, the private sector banks have also, stopped. And then if you have rating agencies which keep on saying the emerging markets are basket cases, and they are pro-cyclical to this, are you surprised even the savings of the emerging markets that are safe with the advanced markets don't come back? That's a real serious global recycling of savings resources, which the world has to save because the financial system is a global public good. That's essentially what I'm saying. Okay? And now it's getting dysfunctional because the central banks of the reserve currency countries are printing money all over the place. And then that money is stuck in the large country stock markets and bond markets. And then since the asset managers are also advanced country asset managers, and they're getting even more and more concentrated, and then they say, well, the regulatory rules, the anti-sanctions, et cetera, requires me to put the money back in advanced markets. What happens to the emerging markets? They're really stuck in a bad place. And a lot of it's their money. A lot of it's their money. Not all of it's their money, but a lot of it's their money. So the result is the whole international monetary system is dysfunctional on the current trajectory. And that is why I think the United States has a unique opportunity to start that dialogue, and be the intellectual leader and to a large extent a moral, a stakeholder on the transformation of the financial system to everybody's advantage, including the United States. Okay. Because, if you don't do this, then everybody will do their own thing. And as we know, when everybody does their own thing, the outcome may not be, number one, to the desire of the United States. And number two, it may end up with not just second best, but it could be third, fourth, fifth best. I mean, that, really is a serious problem.
So, Andrew, there's a question that's come in about the climate change that I'd like to sort of combine with a question I had. The question that came in is the climate challenge will require vast sums for greening infrastructure, even in poor countries. Who will finance these? I think you've sort of answered that in part, but I want to connect this to the Sustainable Development Goals of the United Nations, because you seem to attribute some importance to those, to achieving those goals in 2030, just 9 years from now. My feeling is that sort of climate change as a goal, the climate change problem is more important than achieving the Sustainable Development Goals. And it seems to me, if we try to achieve the sustainable goals, we're going to spread ourselves too thin. And maybe we should just concentrate on climate change and green investment and so forth. What's your view of this?
Well, I totally agree with you. Climate change is the priority. The SDG was the expression of that. Okay, you can get a little bit bureaucratic, but even if we fulfill SDG, it's still better than nothing. The real issue is if you step back, if you come as a man from Mars, and then you ask, how is it that central banks can create 8 trillion overnight and yet cannot finance 2.5 trillion on climate change? There is a time inconsistency. Why is that money stuck in short-term funds and you can't do this? So let me give you a simple illustration. I just did a major study with a few friends of mine on climate change issues. There is no technical obstacle to solving climate change. Technically, scientifically, we can do this overnight, but we don't have the political will. Now, the political will says, well, I can't do this because there's no money. Well, if the central banks can create 8 trillion, why can't part of that be used to be allocated for long-term funding? Okay, so if there's a political will, it can be done. That was exactly what Keynes was basically saying. If you have a liquidity trap, in the 1930s, the government spending can get this out of this, and that's what MMT, or variants of it is really about, right? If there is a shortage of aggregate demand, okay, then you fix this by investing in infrastructure projects that deal with climate change. And another part of it you spend on dealing with social inequality. And that social inequality money will come back to you. Let me give you a simple experience that I have discovered as a central banker, right? Because I've, most of my career has been in central banking, but also in development finance. I discovered that if you spend money in the rural areas, the money will go to the rural areas, but it'll come back to the cities. If you spend money in the cities, it doesn't necessarily go to the rural areas. And that's exactly what has happened to the elites of this world, who keeps on thinking that if I put money in the advanced countries, in the urban areas, the money will go to the rural areas. The money hasn't gone to the rural areas, and now they're in revolt. Okay, the populism comes because there's a large part of society which says, I'm not getting my fair share. So finance has a critical role in this. Now, if there's one thing that globally we can agree on, if there's one thing that we can agree on, number one, we not everybody agrees that we should deal with social equality, but I believe in that. But we can deal with social inequality and climate change at the same time, and we have the resources for it, but we don't have the political will. And that issue, a large part of it, since the America is the world's number one in terms of economy, education, health, and military power, with very large stake in all this, America can and should take the lead.
Andrew, we're running out of time, and I can't let you go without a word about Hong Kong, because so much of your career has been in the center of finance in Hong Kong. And Hong Kong has been in the news so much in the last year. A lot of people worrying about the future of Hong Kong, not just as a financial center. Do you have a prognosis for Hong Kong that you'd like to share with us?
Hong Kong has always reinvented itself. Okay. Hong Kong needs to reinvent itself, and it will reinvent itself. I'm optimistic about Hong Kong because it's situated in a good place. It is situated right at the heart of the East Asia, which is still the fastest growing region in the world. Like everybody else, they've got their own homegrown issues that they need to resolve. Every country has that problem now, right? How do you have an internal dialogue to sort out that internal social compact? The fact that the global media is onto country A or country B doesn't make may make some people look good, but really the issue is not about looking good. It's about how do we solve the problems of the people on the ground. And for one of the richest cities in the world not to be able to provide adequate housing for a large part of society, is unacceptable. And that's a social inequality issue that then erupted and was part of that protest, of last year. So we can discuss the issues in many, many different ways, but the fundamental issue of social inequality in Hong Kong was a major driving issue that, one of the richest cities in the world, could not resolve its own public housing issue. Okay, and that some of Hong Kong people still have to live in cages. I mean, literally mean cages, right? And that the average size of housing of the Hong Kong citizen is less than that in mainland China. And 40 years ago, that was unthinkable. I mean, 85, 86% of the Chinese in China own their own property. In Hong Kong, less than 40%.
Andrew, I think we should finish on an optimistic note. So let me say I am optimistic about political will in the Biden administration. I think it's not a question of President Biden and Vice President Harris by themselves making the difference. It's the team that they've brought in to work with them on these issues, including Janet Yellen at the Treasury Department. I think this is it's a solid team. I think they see the need. I think they want to lead in the direction that you've suggested is necessary, and I do feel there is a possibility that the United States will rise to the occasion and help fix the global financial system, as you pointed out, is so desperately needed. Yoon, perhaps you should have the last word here.
Thank you, Lex. I'll just very quickly wrap up. Well, thank you, Andrew and Lex, for the very rich and very informative discussion. I think especially on the issue of U.S. leadership in the global financial market and the global financial market reform, it should raise many interesting questions for the Biden administration as for what role the U.S. wishes to play. You are both gold mines. There are many issues to be deliberated further, such as China's BRI and the future of Hong Kong. We would love to bring you back in the future to join our other discussions related to these issues. So, and also Lex, we look forward to the finalization of your paper on China and the Paris Club, and hopefully we could have another discussion like this one to talk about the that sustainability issue. So with that, I thank our audience for joining on this Wednesday morning, and thank you, Andrew, for joining late from I believe you're in Malaysia, right?
That's right.
Thank you so much for sharing your wisdom and sharing your insights. We have our fingers crossed. Leadership will prevail.
We all pray for the best.
We will pray for the best. But thank you. Have a good night, Andrew, and for the rest of the folks here, have a good day. Thank you for joining. Bye-bye.
Yeah. Thank you, Lex.